sector, how it is active or not active, how it is working to develop new housing in Canada today. Uh, Introducing the panel, we have Mike Lynch, Regional Vice President, Real Estate Finance at BMO Canadian Commercial Banking, and Stephen Vermette, Managing Director, Regional Vice President, Western Canada Business Properties Finance at the Canadian Commercial Banking Division at the BMO Financial Group. So we'll get right into this. As many of us know here, these are not unusual times in the macroeconomic economy and real estate. Moreover, it's difficult to predict how trends might play out over the next 6 to 12 months. In this interview this morning with BMO executives, we're going to learn how one of Canada's largest banks views the issues and if their observations align with investors in the room. So we're going to get right into this, and we'll take some questions later on. The challenge of interest rates. What do we know about inflation and interest rates today? The challenge of interest rates. What do we know about inflation and interest rates today? We'll start with Stephen.
Great, thanks, Brian. Well, the thing that we know is it'll be different tomorrow. We are certainly taking data and listening and learning what's happening in the market. It does change week to week. I think what we do know is the outlook is for lower rates. The question is, when does that start? So there is a common view in Canada, rates will start to drop in June and will continue to drop over the course of the next 2 years. That's fairly confident about that. Again, the question is when, and as data comes out, if the economic news is a surprise to the negative, that's good news for interest rates. If it's a surprise to the positive, that's what causes us to pause in terms of when will those rates start to fall.
And Mike Lynch.
Yeah, I saw this ad. I actually looked at BMO Economics report. It released it on the 25th, so on Monday. And they are forecasting the first drop in June. So a 25 basis point drop and then step down to the end of the year to equate to a 100 basis point drop. So from 5 to 4. And then the following forecast is another 100 basis points throughout the next year. So that's good news. But as Stephen said, it's the rate is one data point. It's like that iceberg. That's just one data point. There's so many things below the water that can affect the rates. And if you look at any bank's kind of economic forecasts, go back a year, go back 6 months, they're constantly changing, right? So it's someone's best guess. I think you're going to have on the agenda, you have an economist speaking next. So we'll see what they say, but everyone thinks they're going down based on inflation. They want to keep it, as long as it's not going to wait till it hits 2, but as long as it's trending downwards, that's when the Bank of Canada will have confidence. So that is, I think it's 2.8 was the last metric that was released. So yeah, we're pretty confident that they are going to fall. Just when is the big key.
How cautious is BMO in your team in the current environment? So I'll repeat that question. How cautious is BMO and your team in the current environment? Stephen.
Today, we are open for business. If you look back the last 18 months, as there were conversations and views and concerns about the potential for a recession, there have been some regulatory changes on the back of those sorts of things, where the regulators have said to the banks, you need to hold more capital, you need to prepare for a recession. When those things happen, the bank market tends to tighten up. Access to capital is a little tighter. As we sit today with a view that rates are coming down, inflation looks like it's getting into check, those pressures are being relieved. So we're very bullish. There's going to be economic challenges. We're still in a high rate environment, but we're open for business.
Mike Lynch, the question about being cautious in the current market. How cautious are you?
Yeah, so just for perspective, Stephen's group looks after builder property finance, so hotels, self-storage, student housing,
Seniors
homes. Yep. And so mine is more residential construction, industrial, commercial, retail construction, multifamily construction. So we have, similar views, a little bit different on, yes, we have lots of capital. I think all banks are flush with capital, looking to meet their goals by lending into real estate. There's certain asset classes that may not be as exciting to the banks right now. In the office, I think that's the clearest one. Is that's a very challenging ask for anyone. So our old parameters, our lending parameters have stayed pretty constant, with the exception of office. We changed it a little bit, and the reason why those have changed, and Stephen alluded to it a bit, was is that me? So the reason it's changed is the regulators actually increase the reporting requirements on some of these asset classes. So they want to know, and this is awesome, the regulator of all the FIs, and they want to know what's your exposure to office, so they're asking 1,000 more questions. The more questions get asked at that level, credit automatically tightens up on those asset classes. So that's definitely a change. But we stick to kind of what we've always done, is stick for builders developers. When I mean for builders developers, I classify it in 3 components. So the first one is experience. Do they have experience in the asset class that they're building? Do they have, if they don't have experience, are they hiring the right third parties, architects, general contractors? And then we go to, outside liquidity, net worth. We need someone to be able to step up, if required. So that's important. So we definitely look into that. And that more than ever, with interest rates high, we definitely dig into those. And then the third component would be, whatever product type they are doing. Is there pre-sales? Is there mortgageability? Is there lease up? So those are the 3 components. If we'd like everyone to be great in all 3, but most times they're great in 3 and a little bit off on 2, but there's balancing acts. So yeah, that's it.
From your perspective, how are investors tackling the market? What have you observed with your clients in pipeline for new activity? I'll repeat the question. From BMO's perspective, how are investors tackling the market today? And what have you observed with your clients in pipeline for new activity? Stephen.
So as Mike mentioned, our business is real estate based operating businesses, hotels, seniors housing, student housing, storage, parking. It's been an interesting 3 years through COVID. I think today it depends on the sector. So hotels are viewed as a kind of an inflation hedge, because they have the ability to manage rates on a daily basis. So hotels have recovered over the last 3 years super well, performing at kind of high watermarks today. There's a lot of people that touch real estate that are casting an eye to hotels because they perform so well. Seniors housing, again, another challenging story through COVID. That market was, people were basically kind of sheltering in place to ride it out. We're starting to see activity in that space. That's buying and selling of assets, trading of assets. Same for hotels. More activity in the hotel space this past 6 months than we've seen in the last 3 years. Other sectors are kind of doing what they typically do. I think it's generally pretty positive, and that with the outlook of lower rates, that tends to help everyone's outlook.
What deal size is getting done today for acquisition or new development? Would you say, one category under 5 million, second category 5 to 10, third category 10 to 20, and then 20 million and up? So 4 categories. And how has that evolved since the pandemic? So are you seeing more smaller deals or more mid-market deals, or less larger deals now in the past few years?
Yeah, I'll share a view on the sectors that I see on a daily basis. Through the pandemic, there were just not a lot of activity. The delta between a bid and the ask, regardless of the sector that you were in, was pretty wide. Nobody wanted to sort of close that gap. Today, hotels very active. We're there've been a couple of multi-$100 million transactions in the last like closed in the last 60 days. So we're seeing that kind of activity. We're seeing activity in the smaller, so I'll say kind of just under 10 million on occasion in hotels specifically. Seniors is a sector that really the small transactions, say under 10 million, there isn't anything there. But transactions kind of that 100 to 200 million, we're seeing those a little bit more today than we have with some stability in the sort of financial performance of the sector. That's going to take some time to sort of build some confidence in that space. Mike deals in a different sector, and
yeah. So my sector, most loans are 20 million plus. So I don't really have a good view into the 5 million or 10 million, but I would say the opportunities for a long time took a while to actually come up because, as you mentioned, the bid and the ask on land was not even close, right? So now with interest rates being longer for a longer time, this has caused some stress on people who've had some land loans, and the carrying costs have become too much. So they're basically having to liquidate. So there's a lot of those type of appetites or loans going kind of sideways with banks where they have to go in receivership. So those are the opportunities that people are looking at. And a lot of them were basically in the high rise space that they weren't able to get zoning, and now the people are looking at them now are pivoting to more of a rental basis and taking advantage of the CMHC MLI Select programs where you can kind of maximize IRR. But yeah, those are most of the opportunities we're seeing.
Is it your opinion? We've heard about inflation linked to increasing operational costs. So owners are have two hurdles now: operational costs such as insurance, labor have increased dramatically, versus rising rates. So what in your opinion do you think is having the biggest impact? Depending on the type of firm, it's the interest rates. Others will say the operational costs have changed dramatically. Just want to get your opinion on
yeah.
that.
So in my business, labor is an important part of that equation. These are operating businesses that require, in most cases, save for self-storage, which is kind of those sorts of businesses sort of run by themselves. But seniors and hotels are certainly labor-based businesses. Higher costs have been a challenge, particularly through COVID. Labor costs were important. As COVID evolved and is in the rearview mirror, kind of trade labor costs, which have remained on the high side, introduce higher interest costs. So at the end of the day, all of those costs, affect these businesses' bottom lines. It's the bottom line that allows people to pay for the debt that they're looking for when they do transactions. So I'm not sure one trumps the other. It's all costs. They all need to be managed. The outlook of lower rates is certainly positive for every business. And labor is, I think, the sectors that have been challenged managing labor costs. I think there are getting control of that. So the outlook is better today than it has been in the last little while.
Mike, how much of the debt in Canada is short-term, 5-year versus long-term fixed? If you want to break down
I don't have the
what's out
exact specifics, but all I can reference is what people are doing when loans are turning over. So we do construction as well as we have some term on our book as well. So most people, it depends on what their appetite is, right? Like if they might be going short term because they think rates are going to go down, or if they're risk adverse, they might lock in for 5 years. Because I'm just looking at our own kind of cost of funds within BMO, and really the 3, 4, and 5-year rates, or at least our cost of funds, are plus or minus 5 basis points of each other. So it's up to the individual. Most people are picking a short term and hoping to benefit from the rates decreasing in the long term. but people were doing that 2 years ago, and then they came back out, and now the rates are even higher. So it's just like when the rates will fall, no one actually knows. But I would say in Canada specifically, most people are in the 5-year range for the stuff that I look at. I don't know if it differs from what you look at.
Yeah, no, I would say the same. Um, the yield curve, the Canadian senior debt market for the most part is historically 5-year terms. The yield curve is downward sloping. It's pretty steep at the first couple of years. And as Mike's pointed out, 3, 4, and 5 years is flattened out. I think it's important for people to understand probably 80% of the yield curve reflects where, what we expect rates to be in the future. And so for those that are saying, I don't want to take a 5-year, I want to stay short because I think rates are going to fall. Well, the reality is that's already baked into the yield curve. And so what we're seeing in our business, people are deciding, do I take 3 years as an example to take advantage of the 100, 150 basis point savings versus a floating or a short 1 or 2 years, and hope that 3 years from now the whole yield curve will be lower, that they can take advantage of. So that's the decision making that we're seeing in our business, somewhere between 3 and 5 years.
You're seeing that across all property types?
Pretty much. Debt is debt. When you talk to operators of a business, they're all making, the same decision based on the simple reality of there's a cost to the capital that we're lending to them.
Moving to our next discussion point here about the rental rates, which have been very high, we've had strong demand in the expectation of rental rates remaining strong despite higher rates due to overwhelming immigration, the housing shortage. So we talked about rates potentially coming down. Is your expectation that rental rates will remain strong because of this overwhelming immigration and the shortage in housing? Mike?
Yeah, I 100% agree that rental rates remain strong. It's just the immigration that we have coming into BC, even if rates fall and that will, unleash some of these renters to look at pre-sale condos, we're still at, less than 1% vacancy, right? And so these rates are going to continue. I don't see them stopping. I think the problem will be, how do we get the labor to build out these construction units to, once supply is there, that's eventually will bring down the rates, but we don't have enough labor to build it right now. So yeah, I think the rental rates will continue. Maybe not as aggressive as they have. Like I know rents are turning over now and they're 25% increases, maybe not as much in the future, but they're definitely, the demand outweighs supply.
Steve, do you want to buffer any of that?
Yeah, rental rates in the kind of the generic sense is less impactful depending on the sector that I'm speaking about. In seniors, we're seeing the same thing. We're seeing, in fact, this is an environment where post-COVID, we're starting to see rents increase. That's actually been an important element of managing kind of the bottom line for operators in that space. Hotels, as I mentioned, rents is a kind of a different concept there, but the average daily rates are at all-time highs in the most BC markets. Really taking advantage of the domestic traveler, and as that kind of weans off, people start traveling internationally. There is a return of business travel that's going to keep rates high, we think, in the hotel sector.
So Steve, you seem very bullish on hospitality.
Yeah,
maybe second, seniors housing.
Yes, I would say hospitality has really proved out well. Like in banking, we'll spend time trying to sensitize the downside. Well, we only have to look back the last couple of years to really understand what downside is. 90% cut to the top line. And the sector has performed really well. Do I think it'll continue to ramp up the way it's been ramping up the last 12 months? Probably not. The reality is we've, average Canadian consumers have mortgages coming due in the next year or two, that's going to pinch our wallets a bit. That's why we're seeing inflation kind of get under control. Is that going to allow us to continue paying $500 a night to stay in downtown Vancouver? That probably is not going to happen. But I don't see wild volatility. I think that, you know, international travel and business travel is going to return. I, I, I think volatility will be lower than one might expect.
What is your opinion of office? I know there's been talk about conversions and particularly with the lack of housing for students, converting office to student housing or other uses.
Yeah, so office is more of my space, and I know there's like Alberta's converted a lot of office to residential rental. I don't see Vancouver doing that yet. I think our vacancy rate is, I know it's top in Canada. I think it's one of the best in, or one of the lowest in North America. So there's still a demand for office, albeit tempered. I don't see it switching over to student res. What we are seeing is office switch to and pivot just because you can't pre-lease it, right? You can't pre-lease it. So if we're doing construction financing an office building, we want some pre-leasing. No one's willing to pre-lease large pieces now. So what they're doing is they're pivoting to hotels, and then they're doing a forward sale to an entity to take it on. So that's what we're seeing a lot happening in Vancouver, and especially downtown, and that's being receptive from City Hall and the policymakers. But overall office, it's still a challenge, right? There's still people working from home, and I always laugh that one of my large clients has many office buildings in Canada, in North America, a lot in LA too. And he laughs and says, you know, he gets on these banker calls and they're saying, you know, why is lease up down? And he looks at the bankers on the call and he's like, you guys are the problem because you're all calling me from your house, right? Like they're not back in the office. So until people go back in the office and it's mandated, I don't see it coming back, right? Like it's my own office, it's Tuesday and Thursday, it's busy. Every other day, it's not.
We talked about student a little bit, student housing, at purpose-built student housing as an asset class, and there's the multifamily that caters to students or student-driven multifamily. So there's a bit of an overlap between multifamily and student. What is your take on that? I think you talked about it a little bit, but if you want to elaborate.
Yeah, I'll say from our business, our group does do financing of purpose-built student housing. I will say certainly there's more of that done with my Eastern colleagues than done out here. What I tend to see out west is multifamily, located near a university, typically investor owned and rented to students. The entire population of these buildings is often students, but it's not marketed that way. It's really constructed and sold as multifamily. So not something that my teams have done a lot of direct dealing with. It's kind of more befitting of what Mike.
Sorry, what was it? What was it again?
Just in terms of student housing, the
multifamily
multifamily student housing kind of toggle.
Yeah, well, we don't finance this like every year, Mark Group, but I would look at university, which is just around here, as more of an example of what we do, right? So it's condos that private developers are doing.
Yep.
Investors are buying them, leasing them out to students, right? And so that's what we see. But direct, that's not part of my business, but that's mostly in areas that have students around. We fully expect them to be going there.
So we talked about the various categories of investors. It's one category under 5 million, but category 2, 5 to 10, 10 to 20, and then 20 million and up. If you have a family or friend who is in any of those categories right now, what advice would you give a personal family or friend who is either a commercial real estate investor or looking to potentially grow into the student housing or multifamily space?
Want me to go?
Yeah.
Sure. I would say focus on transit. Anything near transit, you've seen all those zoning changes that you can build more. Wood frame, 6-story wood frame, rental, whatever you can build the cheapest. The difference between a concrete building and a wood frame, the rental rates aren't that material, the variance between the two. So it's always been the same. Anything near, I wouldn't really build downtown. Downtown's really challenging. And like from a condo perspective, there's been some failures, some like there's some limited market on the high end. It's tough to build. It's very challenging. I would focus on the Surrey centers. I would focus on Burquitlam. Well, if you drive by Burquitlam now, it's saturated, but those type of areas, maybe Langley, that is going to be able to getting some SkyTrain. So I would focus on anything around there that's close to transit, that fits within that circle, within like whatever it is, 400 meters, 800 meters. That's what I would do. Yeah.
Mhm.
Yeah, I think from my perspective, and this applies across any asset class to any investor or developer, and Mike touched on it earlier. Um, Prepare for the downside. You know, you need to have, don't spend your last dollar developing something, because inevitably there's, you know, some cost uncertainties, there's some surprises that need to, you know, need to be paid for and dealt with, and not by running back to the bank halfway through your project. So, I mean, we always would encourage a balanced approach. Have something in the background to prepare for the downside.
And you're confident rates start to come down around June?
That's our forecast.
All right.
His first cut is in June.
Yeah.
50%,
Yeah,
100%?
put that in the paper. It's
Yeah.
everyone said the rates are going down, right? So it's not like we're out there on a limb. It's what time, but originally it was going to be April. Now it's pushed out to June. And then now these rate step downs are just compressed in the last few months.
So Stephen Vermette, Mike Lynch from BMO, any questions from, I know we have a number of investors, developers in the room, any questions?
Yep.
Question up here.
Oh, sure, Mike. Go ahead.
Guys, I was just wondering what your thoughts are on some of the federal government ideas around low-cost loans to push for more student housing on campuses. And now they're talking about expanding it to on campuses, but also promoting more access to those kinds of loans for off campus. If they do something like what the BC program is, it's, you know, typically a full point or two or more relative to the market rate lower. Do you think that will work? Do you think it will help? I know labor supply is kind of like a side issue to anything that's related to development, but do you think it'll help?
Yeah, from my perspective, and you know, loan programs or government assistance, you know, what we probably see more often than not along those lines would be, you know, CMHC programs. MLI Select is a program Mike referred to earlier. That's a program that, you know, if you can qualify for the project, CMHC rates are lower, so that's a plus for a developer. Probably even more important than the rates is those sorts of programs allow the banks to do 40 and up to 50-year amortizations, which, you know, is frankly a game changer. And the pressure on CMHC to deliver that program over the, you know, over the course of the last year has been just immense. As the world understands that these are available, there's a huge rush. So there's a ton of pressure on CMHC to be able to deliver on that. It takes a long time to get through the program. I've talked to CMHC, and if you work for CMHC, you're supposedly working, you know, 18 hours a day, 7 days a week, and all stressed out. So there is definitely a benefit to developers, and that will generate activity. I think, you know, I think the government needs to figure out how to deliver that, and how to make it available and make it timely as well.
My opinion on that is outside of the labor issues of having people to build it. The only way that this is going to improve is if the government steps up, right? And so they did it with the RCFI program where they would lend directly at cheap rates. That's not great for my business, but is greater for the greater good. It's better. They need to do that. They got to stop giving it to, you know, people who aren't construction builders or developers. It takes forever and nothing gets done. Give the money to the developers who can build, know how to execute, at cheap rates, that's what they should be doing.
All right. With that, Mike Lynch on the right, Regional Vice President, Real Estate Finance at BMO Canadian Commercial Banking, and Stephen Vermette on the left, Managing Director, Regional Vice President, the Western Canadian Business Property Finance Group, Canadian Commercial Banking at BMO. Appreciate you both being here, Mike and Steve.
Thank you.
Thank you.
Great. Thanks, everybody.